you're an Australian investor who's been curious about ethical investing, there's a good chance you've already heard of an ETF called ETHI. But if you're not quite sure what it actually is, how it works, or whether it deserves a place in your portfolio, then this video is for you. Because today, I'm going to break down what the ETHI ETF really is, how it works, what companies it holds, how it's performed recently, who it might suit, some similar alternative ETFs, and the pros and cons you need to understand before you consider investing. Let's get straight into it. ETHI is the BetaShares Global Sustainability Leaders ETF, ticker symbol ETHI on the ASX. The objective is simple in theory. ETHI aims to track an index of large global stocks identified as climate leaders, while also screening out companies with direct or significant exposure to fossil fuels, plus other activities that fail ethical or responsible investment screens. So the pitch is you get global equity exposure, but cleaner, at least based on the index rules. Now here are the key facts. ETHI started on the 5th of January 2017, so it's been around for almost a decade now. It's domiciled in Australia, which simply means the fund is legally based here, follows Australian rules, and is structured in a way that's designed for Australian investors, especially when it comes to tax and reporting. As of January 2026, it has about $3.8 billion in assets under management, which is just a fancy way of saying that if you add up the value of everything inside the ETF across all investors, the fund is managing about $3.8 billion in total. In other words, it's a large, well-established ETF and is well trusted by Australian investors. And the management fee is 0.59% per year, which is the cost of running the fund. The good news is you don't need to pay this fee out of pocket. It's automatically taken out from the ETF itself. So if you had $1,000 invested in ETHI, that works out to be about $5.90 per year in fees. And ETHI tracks the Nasdaq Future Global Sustainability Leaders Index, which is basically a rules-based list of global companies that score highly on things like environmental impact, social responsibility, and corporate governance. So there are 3 big takeaways already. 1 is a real established fund. It's not tiny by any stretch of the imagination. 2 is Australia domiciled, which a lot of Aussie investors prefer because it makes reporting tax so much easier. And 3, the fee is meaningfully higher than many plain vanilla global ETFs. So the obvious question is, if we're paying 0.59% per year, what are we getting? Let's look inside. Like most ETFs, when you invest in ETHI, you're buying a basket of companies. And ETHI is very clear on what's inside on their website. As of January 2026, ETHI's top 10 holdings include Broadcom, which makes up about 6.9%, Nvidia, around 5.7%, Apple, around 3.9%, Home Depot, about 3.6%, MasterCard, about 3.4%, Visa, about 3.3%, Toyota, about 3.1%, ASML, about 2.9%, and Applied Materials Inc., which is about 1.6%. And to round it out, we have American Express, which is about 1.6%. So let's just pause on that. I bet you didn't expect to see Toyota among the holdings, let alone in the top 10. If you expected ETHI to be full of solar panel companies, wind farms, and recycling businesses, that's not what's going on here. This is a portfolio of large global companies, many of which are mega caps, and many of which sit in a growth/tech tilted part of the market. Now let's zoom out for a bit. The sector mix is also telling. Information technology is the biggest slice at about 36%. Financials are also large, about 24%. Then consumer discretionary at around 14%, and healthcare at around 13%. And the country split is heavily US. United States is roughly 74% of the fund, with Japan next at around 7%, and then smaller allocations to places like the Netherlands, Canada, Germany, the UK, Switzerland, and France. So what does that mean in plain English? ETHI is basically a US-heavy global large-cap growth ETF with ethical and climate-related screening applied. That's not a good or bad thing by itself, but it matters for expectations. If US mega-caps and growth stocks do well, ETHI tends to look amazing, and if that style struggles, ETHI can lag. Let's now talk about performance. Performance is always the part people want to look at first, but you shouldn't start there, because performance is the outcome, not the strategy. Returns are the result of your decisions, not the decision itself. For example, 2 people can buy the same ETF and have totally different results depending on why they bought it, how long they hold it, and whether they panic when markets get rough. Chasing what's done well recently is like driving using the rearview mirror. You're buying based on the past, not on whether it actually fits your goals, time frame, or risk tolerance. It's better to get the strategy right first, then performance comes later. Having said all that, here are ETHI's returns after fees as of the 31st of December 2025. Over the last 1 year, ETHI returned about 4.13%. Over 3 years, it's averaged roughly 18.21% per year. Over 5 years, it's averaged about 12.8% per year. And since inception, which is around 8 years, it's returned around 16.49% per year on average. And it's important to understand these are average annual returns. ETHI didn't go up by exactly 16% every single year for the last 8 years. Some years were much better and some years were much worse. That's just how the market works. I'll put a chart up on screen so you can see how it's actually looked over time. Now these are some strong long-term numbers, but there's an important message behind them. ETHI has benefited massively from two things. 1. Being heavily exposed to the US market. And 2. Being tilted toward large growth and tech names that have performed strongly over the long run. That's why I keep repeating, ETHI is not just ethical investing. It's ethical investing packaged inside a global large cap growth profile. So yes, you get ethical screens, but you also get a specific style exposure that can be volatile. And if the market rotates away from growth, ETHI may feel rough. So please keep this in mind. Let's now talk about distributions/dividends. ETHI pays distributions twice a year or semi-annually. And as of the 31st of December 2025, the 12-month distribution yield is sitting at around 2.1%. Now this is important for Australian investors to understand. Because this is a global ETF, the income it pays looks a bit different to Australian dividend ETFs. You're not getting those big fully franked yields like you might from Aussie banks or mining stocks. In fact, ETHI is really a growth ETF first. You're owning companies that tend to reinvest their profits, buy back shares, or growing earnings rather than just paying big cash dividends. Also, quick terminology lesson here, with ETFs we usually say distributions instead of dividends, because the money you receive can come from different sources. It can be dividends from the underlying companies, interest, or even capital gains. So the ETF bundles all that together and pays it out to you as a distribution. Let's now look at the most recent distribution payment as an example. ETHI had an ex-date of the 2nd of January 2026. That simply means you need to own the ETF before that date to be entitled to this payment. The record date is basically the date the fund checks its list of who owns the ETF. And the payment date, in this case the 19th of January 2026, is when the money actually hits your account. So for this distribution, ETHI paid $0.04 per unit. So that means for every share of ETHI you own, you'll receive just over 4 cents. So if you owned 100 shares of ETHI, you'd receive roughly $4. And if you look at the historical pattern, ETHI usually pays a larger distribution around the middle of the year and a smaller one around the start of the calendar year. So yes, ETHI does pay income, but it's not designed for people who are chasing yield. It's designed for people who are chasing long-term growth with ethical and sustainability screens built in. And please note, since it's domiciled in Australia, you can set up a dividend reinvestment plan, or DRP for short. This means your distributions are automatically reinvested for you through new shares. If you're interested to know how to set up a DRP, I'll leave a link in the description below. Let's now talk about alternative ETFs, because you should never review an ETF in isolation. When people look for alternatives to ETHI, they usually fall into two main camps. The first group is global ethical ETFs like VESG from Vanguard or ESGI from Van Eck. These are the ETFs that are most similar in concept to ETHI because they also give you global share market exposure while applying ESG or ethical screens. Just like ETHI, these funds usually exclude entire industries like fossil fuels, tobacco, weapons, gambling, and other controversial activities. So philosophically, they're trying to solve the same problem. How do I invest in global shares without owning companies I'm not comfortable with? The big difference is how they decide what gets included and excluded. ETHI uses the Nasdaq Future Global Sustainability Leaders Index, which puts a big emphasis on climate leadership and sustainability metrics. Funds like VESG or ESGI usually use the MSCI or FTSE ESG frameworks. Those systems tend to look more broadly at environmental, social, and governance scores, and then either exclude the worst offenders or tilt the portfolio toward higher scoring companies. So in practice, that means two ETFs can both call themselves ethical or sustainable, but still end up holding quite different portfolios. One might be more tech savvy, one might be more diversified, one might exclude more industries, and another might just reduce exposure to them. So if you're comparing ETHI to something like VESG or ESGI, you're really choosing between different philosophies of ethical investing, not just different tickers. The second group is Australian ethical ETFs like FAIR, VETH, and GRNV. These funds apply the same kind of ethical or sustainability thinking, but only to Australian companies. So instead of owning global giants like Apple or Nvidia, you're owning Australian businesses that pass ESG or sustainability screens. The big advantage here is that you're combining ethical investing with home country exposure. You're still getting Australian dividends, and in many cases, you're still getting franking credits. But you're avoiding or reducing exposure to companies that don't meet the fund's ethical standards. The trade-off is diversification. Australia is a small, very concentrated market heavily dominated by banks and miners. Even with ESG screening, you're still much more exposed to the Australian economy than you would be with a global ETF like ETHI. So these Australian ethical ETFs make the most sense if you want to apply ethical filters to your Aussie shares allocation rather than replace your global exposure. The easiest way to think about it is this. If you want global ethical exposure, you're choosing between ETHI, VESG, ESGI, and similar funds. And the real difference is how strict the screening is and what methodology they use. If you want Australian ethical exposure, then you're looking at FAIR, VETH, or GINV, and the choice is more about which ESG approach you agree with and how much Aussie exposure you want in your portfolio. I'll put a table up on screen showing these ETFs side by side so you can compare things like fees, holdings, and performance. Feel free to pause the video if you want to take a closer look. And one important thing to understand is that in a lot of portfolios, these ETFs aren't even really competitors. Plenty of people use one Australian ethical ETF and one global ethical ETF together to build a more balanced ethical portfolio. Let's now go through the pros and cons. Let's run through the main reasons people like ETHI. 1. ETHI uses proper ethical and sustainability screening. This isn't just a name, the fund actively excludes things like fossil fuels, tobacco, weapons, and other controversial industries, which makes it a genuine option for ethical investors. 2. You get global exposure, not just Australia. You're investing in large companies from all around the world with a big focus on developed markets and global leaders. And 3. Even though it's an ethical ETF, the portfolio is still well diversified across many well-known high-quality companies. You're not betting on tiny speculative businesses, you're owning established global names. Now let's go through the downsides. 1. The management fee is relatively high. At 0.59% per year, ETHI is noticeably more expensive than plain broad market global ETFs, and over long periods of time, that does have an impact on returns. 2. Ethical doesn't mean perfect. This is a rules-based system, and some companies in the fund may still not line up perfectly with your personal values. You always need to check the holdings yourself. And 3. Because ETHI has a growth and US heavy tilt, there will be periods where it underperforms more generic global ETFs, especially if or when growth stocks fall out of favor. If someone does decide that ETHI fits their goal and wants to invest, the process is very simple. 1. Open an Australian online broker or investing platform. 2. Search for the ticker symbol ETHI. And 3. Buy it exactly like you would buy a normal share. And if you want a full step-by-step guide showing exactly how to set this up, what type of platform to use, how to place your first trade, and avoid beginner mistakes, I've linked a complete step-by-step video in the description below that walks you through the whole process. ETHI tends to make the most sense if you're investing for the long term, ideally 5 years or more, and even better if you're thinking 10, 20, 30 years. You want global growth exposure rather than just a broad neutral market portfolio. You genuinely care about ethical screening and climate-focused investing, not just returns. And you're comfortable with volatility, because growth-tilted portfolios can move around a lot in the short term. On the other hand, ETHI is probably not ideal if your top priority is finding the cheapest possible global ETF. You're investing mainly for income or want things like franking credits. Or you're looking for a fund that's more evenly balanced across value, growth, defensive, and cyclical companies. The easiest way to think about ETHI is this. ETHI isn't just an ethical ETF. It's an ethical ETF with a strong global growth tilt. If that fits your goals and personality as an investor, it could be a really solid long-term holding. If it doesn't, you might find it frustrating during certain market cycles. If you want to go deeper and do your own research, I've put the link to the official BetaShares ETHI fund page, the fact sheet, and ethical screening process in the description below. The fund page website is where you can find the most up-to-date information on things like performance, holdings, fees, and distributions. The fact sheet PDF is a really useful summary document. It shows you just in a few pages what the fund owns, how it works, the risks, and how it's structured. And if you want to understand the screening process in detail, you can check out the documents that explain exactly how companies are chosen and excluded from the portfolio. So if you're thinking about investing in ETHI, I would encourage you to do more research and go read these documents yourself. They're the best place to verify the information and make sure this ETF actually matches what you're looking for. And quick disclaimer, this video is for educational purposes only and should not be considered financial advice. Any ETFs I mentioned in this video are used as examples only and are not by recommendations. Please remember, investing involves risk, so always do your own research before making any investing decisions. And if you'd like financial advice, please go speak to a professional. By the way, if you're enjoying this video and you made it this far, comment the words ethical investing down below so I know who you are. And if you're new around here, what are you waiting for, mate? Hit that subscribe button and join this amazing community of like-minded people who are all trying to level up their life. Also, make sure you're following me on Instagram and X, where I post heaps more lighthearted and sometimes funny finance content. And if you want to go a bit deeper, you can sign up to my free email newsletter, Aussie Money Club, where once a week I'll send you some money tips, major news in the market, or any cool updates from me. And if you want to learn how to invest in your first ETF in Australia this year, check out this video on the screen where I'll show you a step-by-step guide on how to do so as a beginner. And as always, thank you for watching, I appreciate you, and I'll see you in the next video.